Hi, and welcome back to the European VC, the go-to podcast for everything European VC. If you love the show, share it with your friends and join our newsletter at eu.vc. Today, we're happy to welcome Sasha, co-founder and managing partner of Creative Ventures, a firm that invests and collaborates with content creators. This year, they closed their first 20 million fund to invest globally in early-stage companies innovating in consumer internet. Together with his partner Casper, co-founder of Influencer.com, a content creator with an audience of over 10 million across social channels, they help founders navigate the social media and influencer marketing landscape. If you enjoy our content, do support us by hitting the follow button, giving us a review, and following the European VC on LinkedIn.
Sasha, welcome to the European VC podcast. It's super cool to have you here today. You come recommended by a good friend of ours, Bertie from Blue Wire introduced us. Super nice to have you. How are you today?
I'm great. It's super great to be here. A long-time listener. So yeah, it's good to be here.
I always find it a bit humbling when we have guests that listen to the pod. So that's super cool. May I ask you, Sasha, what was the first episode that kind of caught your eye from the European VC?
You know what? I actually don't know. It's a bit like asking, what's the first football game you've ever watched or the first goal you've ever scored. I've completely forgotten. But yeah, I've listened to a lot of great episodes.
Well, I'm happy to be compared to watching football by a Brit, so that's kind of a religion to many, so that's cool.
Yeah, that's the other World Cup first.
Exactly. Sasha, you know the drill, but before we start, we like to hear a bit about your journey into venture, the origin story of your firm. Give us a quick rundown. Who's Sasha and what brought you to where you are today?
Yeah, so I mean, overall, the story is basically going from running a syndicate or investment club into now launching this venture fund, which we closed this year. So the story of it is basically I was working in private equity at a firm called Bridgepoint, doing large cap buyouts and growth equity and consumer and technology. And I started investing in 2019 and created a syndicate with my cousin. My cousin is a guy called Casper Lee. So he was originally a YouTuber. He started making videos in his bedroom in South Africa when he was 16 in 2010, and grew his audience very gradually, but then very quickly to around 7 million subscribers on YouTube and 5 million on Twitter and various more on different platforms. And he, in 2017, co-founded a business called Influencer.com, which is one of the largest platforms that matches brands and content creators together. And they're they've got like over 100 employees, and they're quite a profitable business. And I think one of the largest people doing that in EMEA. So he had this whole founder thing going on, but also this content creator thing going on. This was 2019, and there weren't that many content creators doing investments at the time. But what he and I decided to do together is start investing together, because the context was he was getting quite a lot of deal flow in his inbox from founders wanting him to invest in them. As you can imagine, with cold inbound deal flow, some was really good, some was less good. But he would send that to me, and I would help him to analyze it as the
That is Davidson, my situation with GP. So everyone wants my money, and then I say to David, who should we invest in? That's exactly how it is.
I'm not sure which one you want to do.
You're far from a million followers, Andreas. You still have to do some work to reach that status.
But so what we kind of realized is that Casper had a lot to offer founders in terms of like helping them out and helping them grow their company, giving them advice around how to get bigger and meet people to introduce them to. And I had very little to offer founders, realistically, apart from the fact that I worked in private equity, good guy, know a lot of investors, all this kind of stuff. But I had a lot more access to deal flow, but just not the ability to invest in those great deals. Because I knew people from all the best venture funds from my time in the US and working kind of around the industry. So we decided to get together. I would, provide much of the deal flow. He would provide much of the value add. But apart from just that, we also decided to share all of our deal flow. We took it a step further, not just two of us investing. We decided to share all of our deal flow with effectively an investment club of content creators, celebrities, athletes, musicians, people who can kind of help even more than Casper, or at least in a different way to Casper. And we wouldn't charge them any fees. We wouldn't charge them any sweat equity. We wouldn't try to broker anything. We didn't take any economics from it whatsoever, apart from the fact that we would just co-invest in the deals. So we started doing that in 2019. We invested in a few companies over the next 2 years. Some of them ended up being good investments. We got lucky with them. We invested alongside some really great venture funds, which used to be cool to do back in the day. We invested with like Index and Axel and General Catalyst and various other people like that. And then we used that track record to raise our first venture fund. So I left Bridgepoint in about 2/3 of the way through 2021 with an anchor commitment in place. And then we closed our first fund at $20 million in commitments in March of this year.
Before we dive more into the firm, I need to just double click, and I've spoken to a couple of guys and girls doing that model of working with celebrities or footballers or athletes in general, and I've kind of been probing around the value add there and how founders perceive it and how you activate it and that kind of thing. Could you just both indulge? I think everyone thinks it's exciting, so that's one reason to dive into this topic, but also trying to understand what is it that founders see in this and where should people be wary, is the value add real, or is it more like okay, it's just cool? So we just had Monique from Pact and their fund. They have Anne Hathaway as one of their LPs, and I can't help but think that in one way it's absolutely great, and on the other hand, that was the fucking headline of the article, right? And is that what you want? So I'm curious to hear how you think about this and how everyone you're working with think about this part of celebrities in your fund and in your investment.
Yeah, so it's a great question. I love that this is now a topic, because back in the day it was like nobody was really talking about it as much, but now it's definitely a hot subject. So I would say the first thing, just to say before even answering the question, just to provide the context, is there's two very different ways to do this that I think people sometimes they sometimes conflate them in their minds. One of the ways to do that is you get Will Smith or some super famous person and you tell them to invest 100K, but then they also get 100K worth of advisory shares for adding value to the company. And basically you get a blended lower valuation effectively for this investor, with the idea that at some point they're going to post about it on social media or tell their friends about it or do something to help the company. That's one way of doing it. The other way of doing it, which is what we do, which is what we have done, what we still do, which is very different, is we don't ask for any discounts or any sweat equity or any payment for value add. It's just we're investing in VC-led rounds on the exact same terms as the VC. And the reason that's important is because it means that the value add does not need to be the value add to be worth taking for the VC. It doesn't need to be transformative to your entire company. All it needs to be is just 1% better than another nameless VC who provides a relatively similar value add to all the other VCs you have in your cap table already. So I think that's the kind of most important context setting. When it comes to actually what that value add can look like, it's interesting because it can come in a whole load of different ways. I mean, it can be anything from posting on social media for free. We've had our creators who've invested with us do campaigns that have got tens or even hundreds of thousands of likes on social media alongside our portfolio companies for free. We've had for example, we invested in a company called Lottie, which is a care home platform, and that was I think we did this earlier round, and it's a general catalyst portfolio company. They did a campaign for carers, for care home workers, and they want to publicize it. We'd invested in that deal with a kind of a bit of an uncharacteristic co-investor for us, but he's a guy called Anton de Beek. He is the judge on Strictly Come Dancing here in the UK, and so he's an old man. He's an old guy. The old ladies love him, and effectively he went on Good Morning Britain, which is the biggest morning show in the UK, and did a whole segment talking about this campaign they were doing. And obviously that was totally free. Their web traffic was higher than it's ever been, and that was actually last week. So we see examples all the time of the direct value add. But I think what's also really interesting for us is some of the indirect stuff. These creators often and these celebrities end up being super well connected. They can open a lot of doors in terms of introductions, in terms of people wanting to do what they say. Even somebody cold, they can reach out to somebody cold and they'll reply. If you've got 3 million Instagram followers and you reach out to somebody cold, chances are they're going to reply. So that's the kind of indirect stuff. And then taking it to even one step further than that, there's the whole advisory layer. So it's like these people understand how to engage consumers. That's their entire job, and that's what they're best at. And so we love to advise, or Casper especially loves to advise founders on how to position their own social media, how to basically give off their brand and everything like that. And then on top of all of that, when it comes to the creator side, our value add as a fund is that we have this whole solo GP mentality. We don't have a complicated investment committee. There aren't 4 different layers of people all need to sign off a deal. You're dealing with 2 people. It's me and Casper. And that's what we need to think about. So we've had the pleasure of having founders who've really liked us having involved and who've given us super pro rata basically whenever we've wanted it in follow-on rounds. We're really confident in our value add.
Now's the big question, I think. Because there's anything you could be certain of, then it's that a celebrity will also be a prima donna, or at least that is what people would expect.
Yeah.
So I'm super curious to hear, how do you think about involving these and managing them as stakeholders and that kind of thing? I'm super curious. So I met at Web Summit, I met Anthony Saleh, who's also, the producer of Kendrick Lamar and I don't know
Yeah.
what. And it was interesting to hear how he thought about his producer business and his VC business. That's then a $700 million
Yeah.
fund. So it's a bit of a different ship, right?
Yeah.
But hearing about how those two work together and how he thinks about it, I'm super curious to hear how you think about this and the stakeholder management that's involved.
Yeah, it's interesting. I actually very rarely get asked this question, so it's good to actually think about it myself. I mean, it's a very simple answer, which is you're absolutely right. There is a lot of stakeholder manager, there is the management, there is this whole prima donna aspect to it. But from a founder's perspective, I take that. Casper and I take that. So we are the points of contact with the creators most of the time. So for example, when it comes to like due diligencing a deal, getting them involved, I will be the one fielding the questions to them and putting it in a way that they will understand. And then when it comes to sharing updates and things like that, I'm the primary point of contact for them. So there is definitely a lot of stakeholder management, but fortunately for the founders, that's kind of sits on me and Casper.
Yeah.
On that topic, I'd like to actually ask you something, because I've also been talking with a couple of funds, syndicators, whatever in this space, right? Mostly athletes, to be honest.
Yeah.
And I found myself feeling quite skeptic about the terms of some of these funds in terms of the conditions they're granting to, in this case that I'm referring to, athletes or influencers, right? Just one type of influencers compared to other LPs. And kind of looking from the outside, my immediate thought was like, I'm not sure I would like to be an LP that is not an influencer in this fund. And I'd like to abstract myself from that and ask you kind of from an overview standpoint, how do you guys think about, the different profiles of LPs you have? Do you have special terms for influencers? Yes, no, why not? Kind of what's your thinking there?
We don't have any influencers as LPs. People quite often confused about this. It's very clear. We don't have influencers or LPs. Our LPs pay fees. They sit in our fund. Our kind of what we call our fund zero had, when we were raising the fund, it had, gross IRR of over 100%. We had a, DPI of almost 1 times, like 0.75 times in 2 years. We had a good returns that attracted LPs to want to invest in our fund. On the side of our fund, on a deal by deal basis, we can bring in content creators, celebrities, athletes, people like that into deals. So it's not like we have a 2-tier LP base. We have an LP base,
that is
we have a syndicate. You see why that's different?
Yeah, that is very different. But then the follow-up question is, do those co-investors then have special terms? Because I've also seen that, right? So I've seen setups where you have funds and then you have syndicates on the side, but these syndicates actually have really, really sexy terms versus the actual LPs.
You're gonna love it, David. You're gonna love it. So no, they don't. There's no terms. They just invest in the companies. We just share deal flow. I mean, it's like we don't even create SPVs. That's what really surprises people. We don't create SPVs for our creators. We literally just introduce them to the founder.
Okay.
So again, this is really important. We're not taking any economics from creators. We're benefiting from creators. We're introducing them to founders. It's almost like if sometimes you see a great venture fund do a deal. Sequoia will do a deal, and they'll bring in the CEO of Robinhood to co-invest with them. They won't charge them any fees. It will just be part of the value add process of bringing in people. That's how we do it. So it's not like we're creating this 2-tier economic structure, which a lot of some people think. Is that clear the difference?
Yeah. I'd love to ask, why have you decided against having any of them as LPs?
So I love that question, and the answer, maybe you'd be in a good position to answer, because it's for the exact concern that you've raised. So we don't want preferred terms. We don't want structural complexity, and fundamentally, we don't want to profit from creators. We understand that they're providing us value. Why would we charge them for that? That's why we don't want creators in the fund.
Yeah, that's interesting. Does that mean that you're also, because basically, as you said, right, it's not like you're setting up SPVs and pulling in influencers. No, you're presenting them with interesting deals that they might have potential value add. But does that mean that you're thinking strategically about the base of influencers that you have, which deals you present to each? How does that work? How do you guys manage that internally as well?
That's exactly right. So we think a lot about who comes into each deal. We've had, like I mentioned, Lottie, this care home platform. We brought in, the structure.
Yeah, so you didn't bring that one to Stormzy.
Yeah, exactly. And we also didn't bring our esports company to him. We're very careful and we take it very seriously, because we want for the right fit to come to the right person. We don't just kind of blindly shed. And that's why it's so structurally important that we don't take economics on it, because we have no reason to give away some of our allocation to somebody who's not going to help the company. That there's no reason why we would do that.
And that's
and then I think this is the perfect segue to go into then say, okay, what are the deals? What are you focused on? You're doing consumer internet, but what does that mean exactly? Why do you love that space, and how does it work with the model?
Yeah, so the way we define consumer internet is we have kind of 4 subcategories that we're interested in. The first one is consumer social, and that we include gaming, and as well as obviously consumer social sector of social apps and things like that. The second category is marketplaces. So before working in private equity, I worked at Uber. So I love the whole marketplace, especially asset-light marketplace model. So we do a lot of those. That's B2C and B2B marketplaces in some cases. The third category we do, which is what a lot of people associate us with, is creator economy, creator tools. Got a lot of opinions on what I like there, what I like less there. And then finally, e-commerce enablement. So that's the whole kind of MarTech theme around giving startups and larger companies the tools they need to grow their business. That's what we do. In terms of why we like consumer internet as a theme, I mean, it's a high volatility theme. It's a high kind of, I like to think of it as a high upside volatility theme, where you can, if you can get very, very big outcomes in consumer internet if things go right. And it's a space where you need to really fundamentally understand it to start investing in it. There's a lot of kind of B2B funds that do 1 or 2 consumer deals here and there, and some of them will go well, but it's not necessarily so easy. Whereas for us, it's an area where we're really super focused on. So we kind of know a bit more intuitively kind of what's going to be cool, what's not going to be cool, how you can grow on social media, things like that we think can help our founders and help us select the best deals.
I have to ask, given the turmoil that we've seen in the market and the overall kind of state of venture in Europe, how do you think about it? How do you see it? Because many argued that they're shying away from consumer. Others would argue the opposite. So I'd love to hear your kind of reflections on the market as it is today.
Yeah, so there's always 2 components to it. There's always the valuation environment and how that's changed, the capital markets environment effectively, and then the underlying macro. So the capital markets environment, I would say, has dropped off no more or less for consumer than any other sector. I think a lot of people talk about slowing down consumer investments, but 100 times, 150 times ARR fintech investments, are probably dropping off more actually than your average consumer investment. So I think that's the capital markets environment. I feel like it's pretty much neutral versus other sectors, maybe slightly less negatively affected. In terms of the macro, I mean, I think it'll be really interesting to see what happens with the macro. I mean, I think people will continue to, obviously consumers are going to consume. If the market may go down, let's say the GDP drops by a couple of percentage points. For us, like I used to work in private equity, and when you're buying a market leader that owns 35% of the market, 40% of the market, and the market drops 3%, you're fucked, because you're going to drop 3% because that's what you are. Whereas if you're in a startup that owns 0.1% of the market, and the market drops 3%, and then you double your market share, quadruple your market share, you own 0.4% of the market. Oh no, the market's dropped 5%. I don't care. I still 4x because I drew my market share. So I think in consumer, I think when you're investing in these really early stage companies that are growing share so quickly, you're a little bit more shielded from macro. And I'm not saying that to say it's not an issue at all, something we take really seriously. But I think if you're investing in a company that's going to take share quickly, you're much more protected against it.
I'm curious, your deal flow machine, because you're investing globally. What is the split? How much is Europe? How much is US? How much is everywhere? And then at the same time also, tie that in with your machine, right? Where do you get the deal flow, and how do you build that up?
Yeah, so we are about 1/3 US, 1/3 Europe, 1/3 emerging markets, roughly. We've ended up being more Europe and US skewed so far, but that's the idea. In terms of in terms of our deal flow, how we get it, the great thing about being a super focused sector fund is that people want to send you deals. That's the 2 things actually. It's being a super focused sector fund and also not leading means it's like people will be leading a deal and say, hey, it'd be quite fun to get somebody involved who understands social media. Let's call Creative Ventures. So yeah, we see deal flow from all around the world, everything as far as Southeast Asia to Latin America, US, Europe, anywhere.
And how do you this is maybe a confusing use of the word lead, but how do you use your creators? Is it always you guys finding a deal and then finding a creator that matches? Or is it sometimes the other way around, that you have creators that you then find deals, or make sure you keep thinking about developing in the same, you know, path as which your creator network has
You're
traction?
basically asking hunting versus fishing, right?
Yeah, I love that question. I don't know which way around is hunting or fishing, but basically, I think the first one. Basically, we definitely, under no circumstances, would ever do a deal because we think it makes sense for our creators. That's not something we're doing at all, because like this is important. So our creators are very much something that we do on the side. So we have a venture fund. We don't even always do our deals with creators. We have a venture fund that helps us to understand, except Casper, of course, who's a founder of the fund and himself a creator. But we don't need to invest in every deal alongside somebody else. So we do deals that we love. We do a load of diligence, do a load of calls, do a load of references, do a load of analysis, whatever it is that you need to get to do a deal. And then and only then do we think, hey, maybe it'd be cool to bring somebody else into this. So we'd never like meet a really cool boxer, Anthony Joshua, something like that, and be like, hey, we've got to find a boxing deal in the next 12 months. Anything that's boxing, we'll do it.
Yeah. Nah, but that is actually, you know, it's an important distinction, and it might sound the way you put it here as that would be a ridiculous thing to do, but in a way it's not, right? Because if your core value add is we've got these amazing creators that can really change the destiny of a brand or of an upcoming consumer startup, well, then it maybe wouldn't make that, you know, wouldn't be such a bad idea to say, okay, we've got some huge stars that we can then connect with startups that are strategically aligned with their journey. So in that sense, you know, it wouldn't be entirely stupid. And if you only ran a club, you might run more in that direction.
Oh yeah,
whereas
absolutely. That's absolutely right.
Okay, but that's super exciting.
But
Can you tell me
that's an
anything
interesting
about
topic.
this split?
That's an interesting topic in itself, though, Andreas. Sorry for interrupting you, which is I am actually a big proponent of doing syndicates that you don't need to. The next step isn't necessarily launching a fund, right? The economics are very different. There's challenges, but there's also pros, right? So I'd love to ask you actually that exact question. Why did you guys decide to go the fund route instead of just scaling up a syndicate investment club operation? Because that is definitely something that would be possible. And there's many creative people doing amazing job doing that actually.
Yeah. So, well, on the type of investment club that we were previously running, I mean, we didn't take any economics on that. So that was like, you know, we'd have to just be investing small checks ourselves forever, which obviously is going to take too long to pay off for it to be worth it. In terms of why we, from a GPLP perspective, decided to go down the fund route, I think we wanted the security of knowing that we had X years to invest in a strategy that we believe in. I don't think we wanted to have investors signing off or not signing off on every individual deal. I do actually see, and I do agree with what you said earlier, it can be really good for accountability, and I do think you can end up raising a lot of money, and in some ways maybe even making more economics in a way because of the deal by deal carry.
Exactly.
So I do get it, but I think we wanted a layer of kind of creative freedom that I think would have been hard for us to replicate with a syndicate.
I agree. It's harder to do high conviction contrarian bets using syndicates. Yeah. That's for sure, right? With a fund, you get that mandate, right? Within certain criteria. I have a weird question, and it might not make sense, but you know, I was kind of going over some of your content, and namely like when you guys announced the fund, where you kind of spoke a bit about the different themes that you're looking at, what excites you. Give some specific examples, like not super in depth, but you did kind of outline a few. And I'm wondering how much of an overlap you guys have in the type of deals you're looking at with these Web3/metaverse topics, and how do you guys think about that space as a fund? Is it something that you steer away from? Is it something that you rely on specialist funds? Is it something that you're actually super kind of bullish about and you're actually quite experts about it?
So I've personally invested in Ethereum since 2017. Casper's been doing a lot of crypto stuff personally for a while, but we've never invested a single cent of anybody else's money in anything to do with crypto. And we've done quite a few deals now, and we've passed on everything that has anything to do with crypto. And the reason for that, and we've always felt this way, is that because all crypto, both the tokens and the companies, are so correlated. If you look at the last 6 months and you look at how they've gone up and down, they're so incredibly correlated. Basically, there's a huge amount of beta in the market, or beta in the market, as the Americans say, and that beta is much better expressed via crypto-specific funds rather than by generalist funds or consumer funds or other funds that want to dip their toe in the water in crypto. Because if one of our LPs wants crypto exposure, they should either one, invest in a crypto fund, or two, buy levered long Bitcoin, buy some kind of levered version of a Bitcoin security that they can just get that exact exposure that will be far better than us investing in crypto. So that's my answer on why we've never done any crypto investments and likely won't.
Yeah. What about something like the metaverse and whatnot? Because you do gaming, right? Or there's somewhat of a possible crossover there.
So I love the metaverse as a theme. I just don't think it really has anything to do with crypto. So I think when it comes to gaming, I love open world games as an investment theme. You've got amazing companies like Roblox and Mojang and amazing companies, and which we're definitely interested in. We're definitely looking all the time at gaming companies that are using multiplayer and massively multiplayer worlds. That's super, super interesting for us. But I just don't think necessarily has anything to do with crypto. And then one final point actually is a lot of people think there's a really close relationship between Web3 and the creator economy. That's something you hear a lot, right? It's like a form of the creator economy. So we kind of have quite a strong view that that's not a good. Those two things don't combine together well at all, which I think is a little bit contrarian because a lot of people think they're very closely linked.
Could you deep dive on that? Because something that when I started my question, I read something that you guys wrote saying the creator economy and Web3 are not a good fit, despite many VCs' wishes. And I thought that was a cool sentence. So do deep dive, do expand a bit.
Yeah. So creators, the vast majority of creators, you can call them Web2 creators, basically creators that aren't a very small set of Web3 creators, make the vast majority of their money through brand deals, right? So they're Coca-Cola or some big brand will pay them to promote their brand in their next video. They can get paid anything between $1,000, $100,000, $1 million to promote this stuff. So their whole economic engine is built on this idea that people will trust what they're suggesting, what they're promoting, right? And so if they do the trust in them as a brand is super, super important. So for as soon as a creator does a crypto project or an NFT project or some kind of social token, almost by definition, the way that public markets work is that the incremental buyer will always lose in the end. You can always, your old buyers, people who bought a long time ago, can always win because the value goes up. But the last person to tick the market in the stock ticker will always, by definition, lose because it can only go down from the top, right? And so, by definition, if they do a crypto drop, somebody is going to lose. One of their fans is going to lose, and that fan is likely going to be pissed, right? And so then they start to erode, and they basically, effectively, the word is a rug pull in an extreme case, but they worry about rug pulling their fans, basically. And obviously, the people who are most likely to buy the tokens are the most likely to be the closest to them and will be the ones who might end up losing money. So if you go to the Twitter DMs or Instagram DMs or any kind of email account, any content creator, and you search the word, I've done this, you search the word NFT, Web3, crypto, any of that, hundreds of messages from startups trying to get them to launch NFT projects or do tokens or any of this kind of stuff. And very, very few of them want to reply because they don't want the risk of rug pulling their fans. The only exception to this is what you can call a Web3 specific creator who literally comes up. Back in 2021, you had a lot of like Web3 musicians and Web3 artists and obviously a lot of NFT artists and stuff like that. They don't have that problem because their audience.
Yeah, but that's not a fair. That's not a fair. Yeah.
They're fully aware of the risk that they're going to.
That's not a fair comparison, right? It's like.
I am actually not in total agreement here, or maybe I'm understanding it incorrectly, but so it's one thing that you can offer your product. I could take my podcast and then I could chop it into bits and then sell it to people that love the European VC. That I see, then all of a sudden I'm monetizing stuff and might then do the rock pull as you termed it. But there's also the problem I'm thinking is that when you are a creator and you put it up on YouTube are the ones, or Google are the ones that are making the money because they're their advertisers. It's them that are reaping the advertising, the bulk share of their advertising revenue, right? And what Web3 does allow you to do is to say, well, I will not do an NFT drop that might then pull the rug on everyone, but I damn well will get my own advertising revenue.
Yeah.
So I'm guessing that it's the NFTs specifically that you're more hitting against them.
Exactly. I think I agree with exactly what you just said. I think the problem with it is that everything is tradable. And I think creators often don't want their work to become tradable because if it becomes tradable, it can lose value. And if it loses value, then everyone gets pissed. So it's actually less the kind of technology, the decentralization that's the problem. It's actually the fact that it's
but it's the tradability of okay, I get that. Yeah. Interesting.
Guys, I think we are about to move
It's
into the
always
quick fire.
difficult to come back from a discussion about crypto and Web3 and stuff and then shift to another topic because it's so, you need to really get out there, right? Yeah. David, feel free to wrap us up.
I'm going to wrap us up as we always do, Sasha, with a quick fire round. Quick fire round is when we ask quick answer questions, 30 to 60 seconds each. Are you ready?
I'm ready.
First question is, what areas, sectors, or technologies excite you the most that other people don't really feel that excited about?
I think probably I'm going to use a word that's like super unsexy, and that's kind of the point of the question, I guess. But MarTech, so marketing technology. But I think we're really going to see a big heyday in we already slightly are, but I think it's going to really continuing, and I think a lot of VCs should be more focused on it. It's kind of three reasons, which is number one, marketing mix is just the slow continuing growth of online share of marketing mix and use of social media and everything like that in marketing mix it's not going to stop. It's going to keep going and going to keep marching on. The second one is that regulations and platform policies, you've seen what happened with iOS 14.5 and ATT, are becoming much more onerous and complex and difficult. And there's a lot of technology solutions that are required to navigate that. It's a situation in change. And finally, there's this point that platforms are continuing to take share. I saw last week that if you look at Amazon's advertising revenue, it's absurdly, it's much bigger. It's like almost not even, it's not obviously, it's not as big as a Google or something like that, but it's actually kind of touching it, and it's continuing to grow very, very fast. So much more platforms are trying to basically monetize by marketing, and there's for sure startup opportunities in that.
We agree very much so. Second question of the quickfire: what are your top tips for emerging VCs who are now fundraising?
So there's a few. So the first one would be start with the anchor. So I always say, your time, the percentage split of your time, and it's so obvious, but the percentage split of your time should match the percentage split of your priorities. So for example, if I'm speaking to a really early stage co-founder, so a founder of a business that doesn't have a co-founder, that wants a co-founder, I always advise they should be spending at least 90% of their time looking for a co-founder, even though that's super boring and not the fun stuff. They want to be wireframing and doing all the cool stuff. The time should match the priorities. So I think it's the same with emerging managers. I think 90% of their effort should go to just finding only an anchor LP who's going to take a conviction bet on them. Getting small check commitments from elsewhere is, I think, not, or finding cool people to speak to, or founders, or doing market mapping and that stuff is interesting. But I think the whole effort needs to come on finding somebody who's going to take a conviction bet and anchor the fund. We were super lucky to have that, and so that was basically how we got the whole thing going. Second one. This is interesting. Make LP updates actually good. Put a lot of effort into LP updates, and the reason for that is that the reason a lot of effort needs to go into LP updates is that the returns take a long time in venture capital. Nobody knows what the ultimate money they're going to make, the DPI they're going to make back in the long term. So all they have to judge you on is the quality of your updates. That's literally it. And so you need to make those really good. You need to put a lot of effort into those. You need to make those valuable for somebody to receive in their inbox. So again, I think that's it should be a full week of work for a GP to make the best possible LP update you can.
I would actually add to that that some do it in a super kind of hype way, all good news. It's all good news. It's all everything's amazing. Life's beautiful. Everything's pink. And then suddenly one day there will be bad news. Others do it in a way that I actually love, which is kind of to some extent detailed, yes, but also kind of very very kind of transparent, right, on what's going well, what's going wrong. We're concerned about this. We're excited about that. And I love that, how it shows to the LPs how you think as a GP, what's going on. That level of trust just bolsters, right, with that.
100%.
Yeah, very cool. Third and final question, which is, what has been your most counterintuitive learning since you started Creator Ventures?
Okay, the most counterintuitive learning is that investing with the best funds without doing your own work is not only not a good strategy, it's a very bad strategy. So basically, being manager focused as opposed to deal focused. And the reason I think that is that sometimes they're playing a very different game to an early stage fund. They'll put a small check into something because they want to learn how deal works, or a 5 million check to a $2 billion fund might not be that meaningful to them. So joining them on that deal may not be the smartest thing in the world. So I think a lot of generations, this whole generation of venture capitalists has been built on the fact that the best deals always go to the best funds. But I think what's happened in the last couple of years is that those best funds have become so big and ballooned so much that their deal selection has become so much worse that actually I think there's quite a lot of adverse selection sometimes in just blindly following the biggest funds.
I love that. Couldn't agree more. Beautiful way to end it up. Sasha, thank you for joining us for the European VC. It was an absolute pleasure. I hope to stay in touch and talk to you soon.
Likewise, thanks a lot. Cheers, guys.
Thank you for listening to this episode of the European VC, the go-to podcast for everything European VC. If you love the show, share it with your friends and join our newsletter at eu.vc.